Okay, let's unpack this. We've all felt that, right? That feeling missing out.
Oh, yeah. That stock that got away. It stings.
Totally. Thinking about, say, NVIDIA just 3 years ago, that was what, 1,500% return?
Mm-hmm. $1,000 turning into 15,000. It's incredible.
Incredible. Or going back further, Amazon after the dot-com crash.
Yeah, the big one, 33,000%.
That's just $1,000 becoming over $331,000. That's actually life-altering money.
It absolutely is. And it's, easy to fixate on those past examples.
Right.
But kind of agonizing over the what ifs, that isn't really productive.
Yeah.
The real value is, well, understanding why those blew up. And maybe, just maybe, learning how to spot similar potential going forward.
Exactly. And that's pretty much the mission for this deep dive, isn't it? We're pulling apart a source to understand a specific approach to finding what some call epic life-changing opportunity.
Those moonshot investments, the ones that could potentially give you 10x returns or even more.
So the source material we're digging into today, it's from a YouTube video.
That's right. It's called Buy Now or Cry Later, These 5 Stocks Are Exploding.
Yeah.
And the creator is Joseph Hogue. He's a CFA, a chartered financial analyst.
Okay. So the goal here isn't just like, here are 5 stocks.
Definitely not.
It's about unpacking this source's framework. How do they try to find these potential game changers? How do you think about building a portfolio for this kind of, well, moonshot potential?
And then, we'll look at the 5 specific stocks he highlights as examples. Really understand the why behind those picks based on his rules.
Got it. So the power's in the method, not just the list.
Precisely. It's about learning the approach.
Okay, so if you're looking for something with that, explosive potential, 10x, 15x, maybe more, where does the source say you even start looking?
Well, the first big filter, according to the source, is market capitalization. Market cap.
Okay. Why start there?
It's maybe a bit counterintuitive. You see these giant companies now, like NVIDIA, at $3.3 trillion.
Yeah, massive.
And think, maybe they can double again. But getting a 10x or 15x return from something that huge, it's incredibly unlikely just based on scale.
Right. Like for NVIDIA to go up 1,400%, it'd have to become a $46 trillion company.
Exactly. That's bigger than like the U.S. and Chinese economies combined. It's just the numbers get astronomical.
That really puts it in perspective. Hard for something that big to grow that much relative to its current size.
Precisely. So the insight here is to look for companies that are, well, established enough, but still small enough to have that massive runway for growth.
So there's a target range.
Yeah. The source suggests focusing on companies with a market cap between $1 billion and less than $100 billion.
Okay. $1 billion to under $100 billion. That feels like a defined sweet spot.
It is. It cuts out those mega caps that are probably too big for this kind of explosive growth.
And it also avoids the really tiny, super speculative penny stocks, right? The ones that might just fizzle out.
Exactly. Helps filter out some of that extreme risk at the bottom end, too. And, even with that filter, the source points out you're still looking at, like, 75,000 global stocks.
Wow. So it's still a huge pool, but it's a more targeted pool.
Yeah.
Market cap is the first cut.
The first critical layer, yeah.
Okay, so size is number 1. What's the next key factor this framework highlights?
The second big one, according to the source, is having a giant addressable market, a TAM, as they call it.
Okay, a big market. Lots of companies are in big markets, though.
Right, but here's the crucial part. It has to be giant relative to the company's current sales.
Okay. So it's not just being in a big pond, it's being a small fish in a really, really big pond.
That's a great way to put it. The company needs just a massive runway to grow into.
Got an example?
Yeah, the source uses Toast again here. We mentioned them briefly. Last year, maybe $5 billion in revenue, roughly.
Okay.
But they operate in the U.S. restaurant market. That's estimated at like $1 trillion. With maybe 875,000 locations.
$1 trillion. Wow.
And Toast, right now, has maybe 13% penetration of those locations.
So $5 billion in sales against a potential market that's 200 times bigger. That's the runway you're talking about.
That's exactly it. That huge difference is what allows for the possibility of sustained, really aggressive growth, like the 20% plus growth the source expects for Toast.
Because if a company already dominates its market, there's just less room to grow 10 times bigger, right? The market itself becomes the ceiling.
Precisely. This gap, this disparity between current sales and the total market size, that's the insight. It points to the potential.
Okay, that makes sense. And where does the source suggest you find this kind of market size data? Is it easy to get?
It takes a bit of digging sometimes. You can look at industry research reports, the company's own investor presentations. They usually love to talk about their TAM.
Right. They want to show that potential.
Exactly. Or even presentations from their competitors can sometimes give you a sense of the overall market landscape.
Got it. Okay, so filter 1, market cap in that $1 to $100 beer range. Filter 2, giant addressable market compared to current sales. What's the third piece of this puzzle, according to the source?
The third key criterion is a competitive advantage, sometimes called a moat.
Okay, a competitive advantage. What does that actually mean in practice?
It's basically something that helps the company grow faster than its rivals, or operate more efficiently, or protect its profits.
Like what?
It could be lots of things. Maybe superior technology, like they have the best AI or something. Maybe they control their whole supply chain that's vertical integrated.
Or maybe just really smart management.
Yeah, or exceptionally strong management, or a powerful brand that customers are really loyal to. Something that gives them an edge.
And how do you spot that? It sounds a little fuzzy sometimes.
It can be. The source suggests one direct way is just to compare the company against its main competitors. What makes this company stand out?
Okay, direct comparison. What if that's not super obvious? Are there other clues?
Yeah, the source mentions looking at the fundamentals, the numbers.
Right.
Like, is their revenue growing consistently faster than their peers? Are their operating margins, basically their profitability from core operations, healthier than the industry average?
Ah, so strong performance can imply an underlying advantage.
Often, yes. Those strong numbers don't usually happen by accident. They can be clues that the company is doing something right, something better than the competition.
Okay, so you filter by size, check for that huge runway in the market, look for that competitive edge. But the source also talks about the strategy for investing, right? It's not just about finding one magic stock.
Yeah, that's a really, really important point the source makes. Trying to bet everything on finding the single next Amazon or NVIDIA, it's almost impossible.
Nobody has that crystal ball.
Nobody. And even when these companies emerge, it can take a very, very long time for that massive return to actually happen. Remember Amazon?
Yeah, 23 years for that 331x return.
Exactly. And NVIDIA, the source points out, actually had pretty modest returns for a long time, like 6% annually for the first 15 years after its IPO.
Wow, 6% a year for 15 years? Before it took off like crazy around 2016.
Right. That requires incredible patience. Most people don't have that.
Yeah, definitely not typical short-term thinking.
So the strategy the source advocates is different. It's about building a basket, a group of stocks, maybe 5, maybe 10 companies.
That all seem to fit these criteria we just talked about.
Exactly. You're spreading your bets. You're giving yourself multiple shots at finding one or two of those real outliers that deliver those explosive returns.
And then the source says put them in a dark corner of your portfolio. I liked that phrase.
Me too. It's evocative, right?
Yeah.
The idea is you buy this basket, you tuck them away, and you give them serious time. Years, maybe a decade or more.
Let them execute. Let them grow into that potential market.
Right. And crucially, resist that temptation to sell just because they've doubled or tripled. You're aiming for that 10x or more, and that takes time. Patience is key.
Okay, so the blueprint from the source is clear. Market cap, 1B, $100. Giant addressable market relative to sales, competitive advantage, and the strategy. Build a basket, hold patiently for the long haul.
That's the framework in a nutshell.
All right, so now let's apply this. Let's look at the 5 specific stocks the source actually highlighted as examples that seem to fit these criteria.
Sounds good. Let's dive into those examples. First one up is OneStream. The ticker is OS.
OneStream. Okay, what's their story? What do they do?
So they provide a unified AI platform mainly aimed at corporate finance departments.
Okay.
And the force describes their goal as pretty disruptive.
Yeah.
They want to shift finance from just being, backward-looking bean counter.
Harsh, but sometimes true.
Oh, yeah. To being a more strategic, forward-looking partner across the whole business. Kind of like what Salesforce did for sales and marketing, but for finance.
Okay, that sounds like it could be a competitive advantage, that disruptive angle. What about the market size versus their current size? Does it fit?
It looks like it. The numbers mentioned are about $568 million in recurring revenue last year.
Okay.
But the source points to a potential market of maybe $10 billion just for replacing old, clunky finance systems. And maybe a broader $50 billion opportunity if you include finance and operations more widely.
Wow, okay. $50 billion potential versus under $600 million now. That's definitely a huge target.
Fits that giant addressable market relative to current sales criteria quite well.
And how are they doing on, like, growth and actually making money?
Growth is expected around 20%, according to the source. That can push them towards $700 million in sales next year. And maybe surprisingly for a growth tech company.
They're profitable.
Yeah, the source notes they're already reporting positive income per share, which is definitely a good sign for fundamental health.
That is interesting. What about valuation? Does the source think it's too expensive?
They actually considered it fairly valued at the time of the video, around 9.5 times price to sales.
Price to sales. So how much you pay for each dollar of revenue?
Right. And the thinking is, with 20% growth expected, that growth should justify the current valuation and hopefully drive the stock price higher over time.
Anything else notable about OneStream?
Yeah, the source also mentioned their strong ecosystem. They've got partnerships with big names like Accenture, IBM, Microsoft, plus a growing community of developers building on their platform. That helps spread adoption.
Okay, so OneStream seems to tick the boxes based on this framework. Who's next? Stock number 2.
Number 2 is Toast, ticker TOST. We mentioned them before with the market size example.
Right, the restaurant platform, end to end, you said.
Exactly. Everything from handling mobile orders and payments at the table to managing inventory, financials, operations, even marketing tools, all specifically built for restaurants.
And the fit with the giant market criterion is pretty clear there.
Yeah, it's kind of a textbook example, according to the source, targeting that massive $1 trillion U.S. restaurant industry.
And only 13% penetration of locations currently.
Right, so tons of room to keep growing, just within the existing U.S. market, let alone potentially expanding internationally later.
How's their current performance? Growth, profitability?
They're projecting around 20% sales growth again this year, aiming for about $6 billion in total sales.
$6 billion, okay.
And significantly, the source highlighted that they're now posting positive earnings. Not just positive, but expected to more than double their earnings per share this year, and potentially again next year.
Doubling EPS 2 years in a row, that's pretty impressive growth.
It is. And that purpose-built platform, tailored just for restaurants, that really seems to be their core competitive advantage.
Yeah, being deeply focused on one industry can be powerful. Okay, Toast fits. What's number 3 on the sources list?
Number 3 takes us into space. Rocket Lab USA, ticker RKLB.
Rocket Lab. Okay, the space industry. That still feels, I don't know, kind of like a someday investment for a lot of people, maybe a bit like science fiction.
The source actually acknowledges that perception, calls it a science fiction pipe dream sometimes, but then immediately pivots, saying, look, the reality is companies like Rocket Lab are booking hundreds of millions in real revenue now. They're showing significant, measurable growth. It's not just a dream anymore.
Okay, so the growth is real, even if the industry's still relatively young.
Absolutely. The source mentioned growth over 30% annually. They did about $436 million in revenue last year, expected up 30% this year, and then potentially jumping 55% next year.
Wow, 55% jump. Are they profitable yet?
Not yet, but the source expects them to hit profitability next year.
And what exactly do they do in the space industry? Is it just launches?
It's more comprehensive. The source described it as an end-to-end solution. So yes, launch services, especially for smaller satellites, but also manufacturing components for satellites, building entire satellites, and even providing the software to run them.
So they're involved in multiple parts of the value chain.
Seems like it. And they mentioned tangible progress, like launching 5 missions just in the first quarter and landing contracts with the U.S. Air Force and the Department of Defense.
Okay, those government contracts add some serious credibility. How does the valuation look here? Is it expensive?
This one, the source notes, is definitely pricier than the others on the list, trading around 27 times price to sales.
27x, that's quite a bit higher than OneStream's 9.5x.
It is. So because of that higher multiple, the suggestion from the source wasn't necessarily to jump in with both feet right away.
More like
consider accumulating some shares, maybe layer in over time, perhaps wait for a pullback if one comes. The growth story and the long-term potential of the space industry are exciting, but the current valuation suggests maybe a bit more caution on the entry point.
Okay, so high growth, exciting field, but factor in the higher valuation. Got it. Fourth stock.
Fourth is GitLab Inc., ticker GTLB.
GitLab. They do. Developer tools, right? Something with code.
Exactly. They offer an open source platform for software development covering security and IT operations too. It's often called DevOps.
And they have AI involved now too.
Yes. The source specifically called out their AI-assisted coding tools. They described GitLab's platform as one of the most comprehensive tool sets out there for developers. Helps them write code faster, deploy it reliably, manage the whole process.
So that comprehensive, efficient platform, maybe boosted by AI, Sounds like their competitive edge.
That seems to be the argument, yeah.
Yeah.
The source suggests this tool set delivers real ROI, real value for their business customers, and that's driving adoption.
Any numbers on that adoption?
Yeah, they mentioned adding over 9,300 enterprise users recently and hitting a milestone of 1,000 customers who spend over $100,000 a year with them.
Okay, that $100 K plus customer number is usually a good sign of enterprise traction.
Definitely. And there's another interesting point the source brought up, Alphabet, Google's parent company.
What about them?
GitLab has apparently been one of Alphabet's larger venture investments. They own shares even before the IPO.
Oh, wow.
And while they did sell some shares recently, about 3 million, the source noted they still own a hefty chunk, like 3.7%, worth almost $300 million.
That's a pretty significant vote of confidence from a tech giant like Alphabet.
It really is.
Okay, so what about GitLab's growth and valuation picture?
Revenue growth is running around 20% annually, expected to top $1 billion next year. Earnings growth is predicted to pause this year, apparently due to some spending and investment, but then expected to resume at around 20% next year. And valuation-wise, the source felt that a recent tech sell-off had brought GitLab's shares down into, quote, value territory.
What kind of multiple was that?
Around 10 times price to sales, which, as the source pointed out, is quite a discount compared to where it used to trade, maybe closer to 13x or even 16x sales in the past.
Okay, so a strong platform, AI angle, big tech backer, decent growth, and maybe an attractive entry point after a pullback makes sense. What's the fifth and final stock from the source?
The last one is SoundHound AI, ticker SOUN, and the source was pretty explicit that this was their personal favorite of the 5.
Ooh, okay. Personal favorite. That always catches the ear. What's SoundHound AI all about?
They're focused on conversational AI. Voice assistance technology, basically.
Like Siri or Alexa, but for businesses.
Kind of, yeah. The source sees them as a leader in this space, really benefiting from this wave of practical AI applications hitting the real world, especially using voice.
Okay. And the market potential, does it fit the framework?
Hugely, according to the source. They estimated the market for conversational AI at maybe $160 billion, but they thought the actual opportunity could be even bigger than that.
160 billion plus. And SoundHound's revenue last year was
just $85 million.
Wow. Okay, that is an enormous gap. Classic, big addressable market, tiny current share.
Exactly. Ticks that box very clearly.
So how fast are they growing into that massive opportunity?
Really fast right now. The source said revenue is expected to almost double this year, hitting around $160 million.
Double? That's serious growth.
It is. And they even suggested that next year's forecast, which is around 25% growth, might end up being too low. They thought it could get revised higher as more projects and deals ramp up.
Okay. Can you give some concrete examples of where their tech is being used?
Yeah, the source mentioned deployments in cars across Europe. Think voice control for navigation, music, etc.
Okay.
And also expanding into AI for drive-through ordering systems at fast food restaurants, partnering with big chains there.
Ah, the drive-through AI. You can definitely see that becoming widespread. Makes sense.
It's a very tangible, understandable use case.
So what's the deal with valuation and the source's strategy here, especially since it's their favorite?
Well, the shares have been volatile. The source noted they came down hard from a peak valuation, which was way up at like 90 times price to sales.
90x. Wow, where is it now?
Around 34 times sales, according to the source at the time. Still sounds high, right?
Yeah, 34x is still pretty steep compared to, say, GitLab at 10x.
True. But the source made an argument based on that rapid growth. If revenue really doubles this year to $160 million.
Then the valuation based on next year's expected revenue looks better.
Exactly. That 34x multiple on last year's sales would effectively become more like 23 times based on this year's expected sales. And with that 88% growth rate, the source basically said the shares become a steal at these levels looking forward.
So the strategy is...
The source suggested continuing to accumulate shares, basically buying into that growth story.
And this is where they mentioned their own position.
Yes. They disclosed they personally had over $16,000 invested in SoundHound. Said they'd actually taken some profits earlier when it ran up high.
Okay.
But then bought back in more recently under $9 a share, building up to 10,000 shares because they believe in the long-term growth.
All right. So SoundHound AI, huge market, explosive current growth, real-world applications, and a valuation that, while still high on trailing numbers, looks potentially much more attractive based on forward growth, according to the source.
That's the picture they painted. And again, it's crucial to remember, as the source emphasized, these 5 stocks, OneStream, Toast, Rocket Lab, GitLab, SoundHound AI, they are presented as examples.
Examples applying the framework.
Right, demonstrating the market cap filter, the huge addressable market need, the competitive advantage piece.
Okay, so bringing this all back to you, the listener, the real point of this deep dive isn't just, here are 5 stocks the source likes.
Absolutely not. Please don't just run out and buy these based only on this discussion.
Right. The real value here is understanding the framework that this source uses. It's like getting a lens, right? A systematic way to sift through the market, looking for companies that might have that explosive long-term potential.
Exactly. Because if you understand how these stocks were picked that focus on the ton-buy $100 B market cap, the check for a truly massive market they barely penetrate yet, the hunt for a real competitive edge.
Then you have a set of criteria. It's a toolkit you can potentially use to analyze other companies in other industries to maybe find your own candidates for that moonshot basket.
It really hammers home that strategic point, too. Find a group 5, 10 maybe, that seem to fit these tough criteria. Invest. And then the hard part, be patient.
Right.
Really patient.
Commit to that long-term hold. Because these kinds of life-changing returns, if they happen at all, usually take years, often a decade or more for the story to fully play out.
Yeah, it's about letting the company execute and grow into that huge potential you identified.
Okay, so this deep dive gave us a pretty clear, actionable framework from this specific source for trying to identify potential moonshot stocks.
Yep. Filter by market cap, 1B $100 Bs, demand that giant addressable market relative to current size, and find evidence of a durable competitive advantage.
And we saw how the source advocates for investing in a basket of these, not just one, and then holding them for the really long term, letting time and business execution hopefully work their magic.
And we walked through those 5 examples: OneStream, Toast, Rocket Lab, GitLab, and SoundHound AI, understanding the specific reasons the source gave for why each one seemed to fit parts of that framework. Disruptive tech, huge markets, strong growth, strategic positioning.
It definitely offers a different perspective than the day-to-day market noise, doesn't it? That focus on the super long term.
It really does.
So here's something to maybe mull over. Considering the kind of time horizon we're talking about here for these potential life-changing returns, the years, even decades, it took giants like Amazon and Nvidia before their biggest moves. How does that idea of truly long-term patient investing challenge our usual habits, our tendency to focus so much on short-term results when we look at potential opportunities?
That's a great question to leave people thinking about. How does that long-term view change how you evaluate things today?